me. Welcome, everyone. I'm Professor Alexandra Gerbasi. I'm the Deputy Pro-Vice Chancellor and Deputy Dean of the University of Exeter Business School. I'd like to thank you for joining us today for the second webinar in our COVID-19 Thought Leadership Series. This series is designed to give all of you Exeter alumni worldwide the chance to hear some of the business school's most influential academic staff and alumni comment on issues related to the pandemic. Earlier, last month, you heard Professor Julian Jameson as he spoke about the impact of COVID-19 on behavior and policy. Today, one of our very own business school alumni, Chris Bailey, will share his views and answer your questions on how the current COVID-19 pandemic will impact the world's financial markets over the next year. Chris has worked in the professional fund management industry for almost 25 years after achieving his MSc in Finance and Investment from Exeter. Has worked at long-only and long-short investment institutions as a global multi-asset fund manager and strategist / macro thinker, and in 2013, he founded an investment consultancy business to provide analysis and insights for a wide-ranging global client base. Remember, if you have any questions for Chris, please submit them in the chat line, and he will answer as many as possible. So without any further ado, I will now hand over to Chris. Thanks, everyone.
Thanks so much, Alexandra. I appreciate the introduction. Good day to everybody. Thank you for joining us. Apologies if a few of you tried to join at this time last week, but hopefully we've now got the technology working. I'm Chris Bailey. It's a real pleasure to speak to you all. However, definitely better than looking at my face rambling on. I'm going to share my screen, and hopefully you can see a presentation that I've put together just to talk through some of the sort of the relevant issues around sort of the COVID-19 pandemic and related. I should start off by saying that clearly I'm going to come at the COVID-19 pandemic from a purely financial markets perspective. But clearly there is a broader human dimension to this, and that should never be underestimated. Clearly, it's been a very tragic last few months for the world. However, looking at it from the very, very narrow perspective of financial markets, undoubtedly the way to sort of think about it or try and understand it first is to look at financial market performance year to date. This data is up to the end of last week, and as you can see, there have actually been, this is probably a surprising looking chart for many of you. You know, you've actually got, despite the pandemic, despite all the issues and challenges to economic growth, issues that we'll talk about over the next 20 minutes or so, you still have a number of financial markets. The NASDAQ, the technology-centered US index right at the top there, showing actually very good year-to-date performance. But as you can see, it's not alone. The Chinese market is up year-to-date. A bunch of fixed income bond markets are up year-to-date. And even some of the other markets around the world, in the wider scheme of things, are actually not exhibiting particularly poor performance given everything that is going on. Certainly at the bottom, you have a few areas that have struggled. Famously, things like energy prices have been poor performing year to date. But you can also see Brazil and our own FTSE 100 index have also struggled. But generally, probably a much better performance across multi-assets than you would have expected. And of course, you know, that raises a lot of questions. I don't know anybody who's got a portfolio that looks like this, but it's a good indication of some of these trends. This is the 25, 25, 25, 25 portfolio split equally between global equities, global bonds, gold and cash. So I guess it's a sort of a representative multi-asset kind of portfolio. And what you can see is over the last quarter, the performance has been astonishing from the perspective of sort of certainly a couple of generations of financial market performance. Clearly, it reflects the difficulties in the previous 90-day period during predominantly the first quarter of the year. February and March were very tough times for global investors. But you can see financial markets have bounced back strongly, and it must raise an awful lot of questions, you know, trying to juxtapose the impacts that we see on the economy versus what's happening in the financial markets. You know, something feels wrong, because Just take, for example, this is the US GDP data that came out in the last few days. I mean, this is groundbreaking stuff in terms of the economic impact. You can see, again, a nice long data period. Yes, as always, there are recessions, you know, there is a business cycle and related, but what we've seen in recent months in terms of the economic growth downdraft, it is off the charts. And famously, if you look at something like the UK, you have to go back over 300 years to see a quarterly GDP decline akin to what we have seen in the second quarter of this year. So very, very strange times. So put it all together, as the question says here, why such a bounce? Why have financial markets done quite well or better than people generally would have expected given the pandemic influenced backdrop? The answer is undoubtedly split somewhere between central bank and government policy. What we've seen on the left-hand side, you can see monetary policy via a number of important global central banks. Now, those of you who have been following central banks for a while will know that during the time of the global financial crisis in 2007 to 2009, global central banks discovered sort of a variety of new methods to try and stimulate the economy. Quantitative easing, ultra low interest rates, and those measures have continued generally pretty much unabated for the intervening period. But as you can see by the graphic on the left, the measures, the magnitude of the measures in 2009 pale into an insignificance compared to more recent actions over the last 6 or 8 months or so by various global central banks. So central banks have kind of discovered new ways, and certainly in terms of the quantum, sort of a very material boosting of their stimulus to underlying economies, again via sort of the combination of quantitative easing measures, effectively printing money in order to buy government bonds, combined with, again, an even further reduction in interest rates, and in some cases to both negative and zero levels. Probably the actions on the right, though, that have got a little bit more interest from financial market participants, because it does show that effectively the fiscal policy lever has also been pulled very aggressively. And even though we can debate the ultimate influence of things such as loan guarantees by governments, above and beyond sort of maybe direct cash grants to consumers or to businesses, there's no doubt that, again, in combination, the fiscal policy boosts by governments around the world have been material. And certainly that is a sort of something which I would say is different from the 2007 to 9 period, the global financial crisis sort of reaction, which was much more centered on central bank action, predominantly speaking. So very interesting times. Policymakers have stepped up, but clearly, as we all know, and certainly we know it in the dismal science of economics, there are always trade-offs to this. But financial markets have been buoyed by this. You know, they've seen that policymakers have stepped up. They've seen that policymakers are trying to use these policy levers to try to boost economies through this difficult time. And as always with financial markets, they're looking forward. And as you've seen already, they've bounced perhaps much more than many people would have thought over recent months, reflecting such optimism and such insights. Here's where we are now. I'm not going to talk, you know, as you understand, I'm not an expert on pandemics or vaccines or related. You look at all the same news flow that I look at. But clearly, as we've seen on the graphic on the right, there are, I believe, over 190 now attempts to forge and find a vaccine. And clearly, it would be unbelievably helpful if one of those proved to be very effective in a timely manner. Clearly, we've got a lot of brilliant brains working on it, and that can only be good. And again, that's helped, if you like, support and give confidence to financial markets. The graphic on the left is sort of the kind of economic profile debate. Now, we know very well that there's generally economic cycles. Everybody understands that. But as always, the duration and the sort of the shape of an economic cycle, and certainly at the bounce back from a recessionary period, is important. And clearly, the debate is whether we're going to see a super sharp and materially sized recession, which is going to bounce back very quickly, or whether it's going to be a longer period of concern. And clearly, from a financial markets perspective, they would prefer the former, a smaller, shorter, sharp recession, which then perhaps due to an imminent vaccine or to the actions of policymakers or a combination of the two, you start to see economies bouncing back. By contrast, if you have something a bit more like, as you can see on the graphic on the left, a U shape or an L shape, clearly the impact on things like corporate profitability and cash flows, things which ultimately impact financial markets and financial valuations, is going to be much more material. And in that sort of scenario, you would expect financial markets to struggle going forward. So this is where we are. You know, this is the debate. How effective, how timely, how quick can we find a vaccine, and how that impacts the sort of the economic profile going forward. That's what financial markets are thinking about. That's why they fluctuate, that's why they change, and that's why they will continue to remain volatile over the next little while. Now, economically, I observe, and this data is from the IMF, which undoubtedly can be criticised. The IMF does not have, as nobody does, a flawless prediction, sort of historic capability. But I thought it was useful because, number one, it's in colour and it's got a lot of information on it, and that's always nice to sort of see. What you can see is that there is a sort of what I would call a differentiated expected profile for the global economy in 2020 moving into 2021. Clearly, in every geography, there is a sharp downturn in 2020. We've already seen that with that US data. It's clearly applicable and out there. It's going to be a super horrible recession. We can see that. The question is what happens in 2021. And as you can see by the IMF's expectations, this was published a few weeks ago, building on what they see in terms of the reaction by policymakers, building on what they see in terms of potentially matters such as vaccines and the impact on consumer preferences and the propensity for businesses to invest and related. There is a differentiated geographic profile for 2021. What's most striking to me is that if you look at areas such as emerging and developing Asia, which undoubtedly is focused very much on China, unsurprisingly, you can see that the profile there is much more akin to a sharp V shape, in the sense that there is a mild element of economic contraction this year. In actual fact, if you look at some estimates for the Chinese economy, China's expected to grow this year. You may or may not believe the data, but that's what people are suggesting, and then bounce back in 2021. By contrast, if we look a little bit closer to home, to the Euro area, to alternatively to the United States, you can see that the economic bounce back expected in 2021 does not offset the downdraft expected this year. And in actual fact, there's been considerable debate about whether even 2022 will see a recovery of that economic growth downdraft. Now, you know, this is important because whenever you have, for financial markets, companies that are selling goods, are generating profits from those regions, that potentially can have an impact on their profits and cash flows, but also the valuation you may wish to attribute to those investments. So certainly, geographically, I think we're going to see greater differentiation going forward. And certainly some of the more emerging areas, particularly potentially China, could be doing somewhat better, both in the speed of their bounce back as well as the absolute level of growth. We would kind of expect that given their level of economic development. But by contrast, more developed parts of the world, US, Euro area, etc., it's going to be a little while. It's not going to bounce back quickly. It perhaps in terms of that alphabet sort of soup, as I called it, kind of profile of economies, your risk is of something more approaching a U-shaped recovery in the States or Europe. And obviously that impacts potentially markets and companies and everybody active in those economies going forward. Financial markets, though, they work on the basis of valuations, and as always, and as I've said before, financial markets look forward. That's the reality. They're trying to anticipate the future, and you've got to always try and work out whether things are priced in. So for example, if we have kind of a sluggish, very slow recovery priced into European, UK or American stock markets, then perhaps that's not so much of a problem. What you see here, and the reason I chose this chart, because again, it's in color, and you can tell by the colors sort of the feel for different valuation measures. And I should start by saying that what I've experienced in the last quarter of a century or so, being active in financial markets, is that there is no valuation silver bullet. If there was, I guess the person that discovered it would be on the beach and everybody would be copying them, so it wouldn't work anymore. Reality is, when you're trying to understand what financial markets are thinking, you need a range of insights. And from a more quantitative valuation perspective, some of these measures, things like cyclically adjusted price-earnings ratios, forward price-earnings ratios, trading price-earnings ratios, price-to-book, dividend yields, these are all useful things and many more things you could cite. But what you can see is hopefully some kind of broader trend. And that broader trend, as I say, you can judge it by the colours more than anything else. And obviously the more darker red type the colours, the more expensive versus history those markets are. By contrast, the more greeny style those colours, the cheaper versus history those markets are. And again, things change, and historical insights can be critiqued, but it's a start. It's a way of sort of thinking, of trying to pigeonhole where markets are today. What you can see, broadly speaking, is that the States is quite expensive. By contrast, areas such as Japan, a little bit the emerging markets, which obviously would include China, and certainly the UK, on many measures are somewhat cheaper. Now, I find that very interesting, particularly when I juxtapose it with some of those geographic observations which I made a few minutes ago, because certainly it's telling me that the potential for some of the emerging markets and some of the sort of the less recently heralded parts of the developed indices, including the UK, potentially have chances for outperformance going forward. By contrast, the States, which has been the darling in global markets for a while now, perhaps potentially has some greater headrooms, some greater sort of headwinds. And certainly you may have noticed in terms of some of the detail on the IMF graphic that actually the US bounce back expected in terms of economic growth profile for next year, it's shallower than what's expected in, for example, Europe. And that is a big change versus the last decade. So lots to debate, lots to think about. And of course, probably somebody's reaching for the question, the chat box already thinking, you know, this is fine, but the trouble is that you've got to put it into at this moment in time and looking forward into 2021. This graphic here shows that, judging by where the valuation of the S&P 500 is at the moment, you should expect over the next 10 years some quite suppressed levels of return in the US market. And certainly if I told you what the last 10 years have shown in terms of S&P 500 returns, it's much, much lower than what we've seen. So that's sort of a kind of an interesting backdrop, something to get you thinking. And certainly from a global asset allocation point of view, if the conclusion was the States is going to underperform, that is potentially a huge shift required in many investment portfolios around the world. But as I say, I think perhaps the chat boxes are already full of questions about, hang on, what about the fact that the States is leading in terms of its technological prowess? You know, we all watched the congressional hearings last week, and oh my goodness, you know, it wasn't one conclusion from all of that, and certainly the profit numbers from those big US tech companies, which followed in the day or two after those hearings, wasn't the conclusion that, you know, the States just leads the world in everything that we're demanding more of at the moment: more digital, more mobile, more technology centered. And of course, you'd be absolutely right. I mean, these couple of graphics I think are fascinating. If you look on the left, the tech plus weighting of markets around the world also show material differences. Undoubtedly, the States has a lot more technology within its indices. Perhaps one reason why things such as the NASDAQ index has outperformed materially. By contrast, look at the poor old UK or continental Europe or Japan, much less exposure. And maybe that's an explanation why such indices have struggled a bit more on a year-to-date basis. To look at it another way, you look at the graphic on the right, what you can see is that some of those massive tech behemoths who were appearing in front of Congress, the Congressional Committee last week, you can see they have driven the US indices. Without them, the remaining 495 companies in the S&P 500, that index will be down year to date. So yes, there have been undoubtedly big biases and big trends within global financial markets year to date. And that's something which investors have to think about, because when I look at all of this, I think to myself, okay, I can explain why you've seen the outperformance of the US, why you've seen the outperformance of certain financial markets in 2020 to date. The question is, what happens next? And that is always the question which any investor should be asking, or anybody interested in financial markets. Because another big observation from 25 years of fund management is that hindsight asset management is always the best performer. It's much harder to think about what's going to come next. And so I'm going to share with you over the next few graphics what I think is going to come next, not just over the next 6 months, but actually a bit more bravely over the 2020s or the rest of the 2020s. First observation is that equity markets do look attractive versus fixed income or bond markets. Now, what these graphics show, both for actually the States as well as Europe, and frankly, I could put any other geography you like up there and show something similar, is that at the moment, if you look at equities, or actually you break it down to individual companies within equity indices, you're actually getting a bigger level of dividend income from a yield perspective from those equity indices than you are getting from the equivalent local bond markets, from 10 or 30-year bond paper. Now, back when I was studying at Exeter, that certainly wasn't the case. The normal scheme of things, certainly for much the last 2 or 3 generations, has been that equity markets have the growth potential and therefore yield typically less. Bond markets are fixed principal investments. You know, you get your money back hopefully at the end. You get a series of coupon payments in the interim period, but you know, you don't expect those markets to be particularly remunerative from a total return perspective. They're steadier, they're lower risk, and consequently, you have to be compensated because of the fixed principal structure by higher levels of income, higher bond yields. So typically you would see bond yields in advance of equity dividend yields. You have not seen that, as you can see by the graphics on this page, for many, many years now. We can debate for another time why this is, but suffice to say, from a practical perspective, my conclusion would be, particularly where you see resilient, sustainable equity dividend yields, they are very attractive. You know, you've still got all of that potential scope of growth in equities, but you've also, at the moment, whilst you wait, picking up higher levels of income. That's kind of interesting. So big picture, I would say that my gut feel would be that equities are more interesting than bonds at this moment in time, from an asset allocation perspective over a future reasonable time period. Now clearly that rests on a few assumptions, and I appreciate that. And again, we could talk about the likelihood of a vaccine and everything else. I've got a few words to say about that right at the end of the presentation. But what also strikes me about the world is that we are turning Japanese. And what I mean about that is we've seen a policy response from central banks, which the only equivalent I can find looking through recent economic history is the policy response by the Japanese authorities in the now circa 20, almost now 35 years since the Japanese market peaked. And that's kind of interesting because, and as you can see by the graphic on the left, central banks, in terms of their ownership of local government debt, you can see it compressing up to, mean reverting up to Japanese levels. And I think that's perfectly plausible over the next few years. And as you can see by the graphic on the right, government bond yields across the world are now trading at akin levels to the very negligible yields that we've seen in Japan over, as I say, you've got a 25+ year chart here over the last quarter of a century. So that makes me think we can learn something from Japan. What has happened to Japanese financial markets over this sort of 25-30 year period since the Japanese markets peaked in the late 80s, early 90s? Now, what I've shown you here is actually what they've done. And I've asked the question, is this all our tomorrows? Because there's a lot of data here, so maybe I'll just highlight a couple of key points. The first is that, consistent with what I said 2 or 3 slides ago, is that on average, you've seen in Japan better returns from equities than you have from bonds. So that still holds. So from a big picture asset allocation perspective, expect over the next little while, sort of 10 years, let's call it that, equities to outperform bonds. However, within that split, there are a couple of very interesting trends. And this sort of leads on to some of the, kind of helps me conclude on some of the questions that I posed earlier. For example, when I was talking about the technology sector love up of recent months, and actually for the last decade, to be honest, what you can see is that area which typically investors would regard as sort of being indicative of a preference for growth stocks, actually what we've seen in Japan over the last 25 years, is that actually value stocks have done better on average than growth stocks. You can see that on the very first line on the graphic here. Now, I find that very interesting because that certainly fits with my broader views that actually stock markets, if they are going to progress from here, and certainly in terms of offering opportunity for investors, it's got to be in a broader range of stocks than just a very narrow range of technology or maybe healthcare names. So that sort of fits in with that view. Some of you may also have noted that the volatility stats are very interesting as well, because actually bond markets in Japan have been unbelievably lowly volatile. I mean, these are very, very low levels of annualized volatility. And certainly for those of you interested in portfolio optimization, you'll note that the Sharpe ratio for bonds is pretty good. It's all right. Certainly a lot better than the Sharpe ratio for equity markets, which also raises kind of an interesting question, because if you showed this data to pension funds, they would say, well, it's obvious what you do, isn't it? Because of the sustainability, because of the low volatility in bonds, you have a lot of bond holdings and you have equities as a mixer, as a bit of fun, more volatile, but ultimately give you a better return, but not too much of those. You center your investments on bonds. And that certainly has been, I think, the conclusion of many pension funds over recent years, and certainly has contributed to the fact that yields have compressed so much. But here's the thing. Whilst this has worked for Japan over the last 20-odd years, I have some skepticism about this working across the rest of the world for the next 10 or so years. And I say that for 2 reasons. The first is that Japan, and I've been there too many times over the last 20 years, it's a fascinating economy and society, but it has a few advantages over certain other countries, including our own, including the States, amongst others, which is that it's got a high internal savings rate. It's got what I would call sort of quite a lot of societal stability. And my observation is that elsewhere in the world, we have much lower savings rates. We also have the fact that everybody, as you can see by the graphic on the right, has been building up debt over the last generation or so, certainly particularly in the last 10 years. And to me, that means that the tipping point where people actually say, hang on, I want to be compensated by higher bond yields for the risk of holding a fixed principal bond investment over the next 5, 10, 15, 20 years is pretty high. Because let's face it, what times do bonds do very badly? Bonds do very badly when you get inflation. And Japan hasn't seen inflation for the last 20 or 25 years. Hence the previous chart showing bond markets crunching out a return, not particularly being volatile. I'm not convinced we can say that in other parts of the world, the UK economy, the US economy, among others. And consequently, I think that again drives you towards some alternative thoughts. Certainly, equities are potentially much more inflation resilient. Companies can change the prices of their products to protect their margins and their profits and their cash flow. But it also makes you think about sort of other investments as well. Couple of interesting graphics here. The one on the left is sort of the split of the bond markets. If you split it between inflation fears, if you like, and underlying sort of yield. And what's interesting is that the inflation-proofed bonds, they're called TIPS in the States. They've got a variety of other names, linkers, generally referred to in the UK market. They've been a very popular investment recently. And what this is telling me is that actually correctly the market is starting to worry a bit more about future inflation. And certainly if any of you are monetarist adherents from an economic sort of theory perspective, clearly the quantitative easing that we've seen over recent years has materially increased the money supply, albeit that the volatility of money has been very low. So, you know, something to worry about if you're sort of certainly thinking from that perspective. At some point we will get future inflation. That is not pretty for bonds, hence the popularity of index-proofed bonds such as TIPS and linkers over recent months. The other aspect, something which undoubtedly you've heard about in the press or in financial markets, or maybe have benefited from it directly, has been gold and other sort of real alternative investments. And as you can see, gold, it's been performing recently. It's in absolute terms, it's kicking around all-time highs. I tend to look at it on an inflation-adjusted perspective, and on that basis, it's still got a bit further to go. But recent moves again are indicative of financial markets and financial watchers becoming more concerned about things such as inflation or the impact of too much debt and stuff like that. So interesting times for financial markets. Certainly what I've been practically doing, or what I've been advising or suggesting, has been the juxtaposition of an overweight equity and underweight bond position with an overweight gold or alternatives investment position. That seems to me to be an appropriate structure and balance for financial markets and financial allocations today. At another time, I'll be talking about many other things. We've clearly got a US presidential election in 3 months' time. We've got the Brexit discussions in the UK. We've got some quite fascinating strategic things happening in certainly the relationship between the States and China, all of which individually, let alone collectively, can have big impacts on the world over the next 10 or 20 years. Clearly, though, short term, it's all about the virus, and quite rightly so. The profile of the bounce back or not, the success or not of the vaccine, and during these periods of time, where you should be invested, how you should be invested, and how you should be thinking. You know, certainly from a financial markets perspective, it's been a challenging time, but I think it's also a time where sort of active investing and thinking have been absolutely essential. I'm sure this presentation will be circulated, so you don't need to read all of this now. But I was asked a few weeks ago by sort of what I would hope to see from policymakers over the next little while. And what I wrote, I kind of give a summary of it here, is essentially what I want to see is innovation. Innovation is the key. It's an uncertain backdrop. However, the only way economies are going to recover, individuals are going to recover confidence, companies the confidence to employ people and related, is through innovation and change. And unfortunately, history suggests humans are actually pretty good at that. You know, we do respond well to challenges. We create them clearly as well, but we're actually the reason why we're still around and thriving, if you want to perceive it in terms of our longevity or the level of population versus a few million years ago, is our ability to innovate and change. And I think that's super important, and certainly a very important investment filter, be it if I'm doing stock picking or be it if I'm doing asset allocation work, is thinking who is being innovative here in their policy making, in their choices, in their strategies and related. That's what matters. In life as well as financial markets, how you respond is what matters. That's the key. We're nearly done. As I said earlier, hindsight asset management is a wonderful thing, the best performer out there by far. And I came across the graphic on the left a few months ago, and I loved it because it was beautifully simple in the sense that if you could roll from one big investment theme to another, you'd make a fortune and you'd be a genius and everything would be fine and dandy. Investment markets are a lot harder than that, unfortunately. It's not some seamless shift from one decade to another, from one big theme to another. You know, in hindsight, it's easy to spot. Nevertheless, it's a good debate and something that any investment thinker or person who's allocating to investment markets should be thinking about. What is going to be the big theme for the 2020s? I kind of don't think it's going to be the tech stocks, which are were the big theme of the last 10 years. You know, themes don't tend to repeat themselves one decade after another. I've talked already positively about things like gold, and certainly you could make a case for that. You could certainly make a case for sort of out of favour markets such as Japan or UK or others, or even the sort of the strategic shift of, let's say, China getting more power and wealth over time. What I'd go for though is, as hinted at on the right, I would actually go for a return to active investing. What's really been interesting in recent years has been that the rise of passive investing, of tracker funds and related. I think the world of the 2020s is much more akin to the 1970s, mixed up, different asset classes doing better than history would suggest, a one where active investors, fund managers, thinkers can actually do better. So that's personally what I would go for. All I would say is that I think it's going to be a decade of probably lower, more volatile returns from what we've seen, but certainly not one where there are no opportunities. And, you know, jumping off what I just said about things like innovation, matters such as that, themes such as that are going to be super important. A few conclusions before we open up for questions. So clearly, lots of uncertainty about the pandemic profile, fingers crossed on the vaccine. Clearly that's going to impact the economic profile going forward. Innovation is going to be super important, as already discussed. I do think that markets outside the States, markets with a slightly broader footing in terms of their drivers, are going to be more important. I think it's going to be super important to embrace change and active management and human ingenuity over time. You know, ultimately, I am a glass half full person. It was kind of interesting. I was thinking about back when I was at the university studying for my postgraduate degree. I was a glass half full person then, and I remain one today. And it's ultimately it's been a positive across my investment career, because ultimately, and I'll finish here, you know, I come to the observation and the conclusion that last time we had, or one of the previous times that we had, a serious pandemic, plague type incidents, which clearly massively impacted economies and people's lives in many, many sad ways. After that came the Renaissance. I can't promise you we're going to see something akin to some of the brilliance of the Renaissance over the next 10 or 20 years. But the whole point is that I think ultimately you've got to back human ingenuity. The glass is always half full. There are always things to be doing. And I remain optimistic about the world and opportunities within the markets over the next few years. On that suitably optimistic basis, I'm going to stop sharing my screen so I can see some of the questions, and we'll go back from there. So got a few questions on the right, so I'll just try and paraphrase them, etc. Really great question about brokers and brokerage accounts, and basically it's what impact could this have? Because what we've seen is, okay, you know, I'm allegedly an investment professional. We've seen, though, people having some great success, people who are enthusiastic about markets but coming from unconventional backgrounds, which is great to see. You know, you always want to see people engaging in financial markets. So the question is this crazy? Is this sort of massive build-up of things such as brokerage accounts something which is madness? The answer is it's indicative of an unsustainable hope. Because what you get is that, and I saw this for the first time on a live basis at the time of the dot-com excitements in the sort of the 99-2000 period, where suddenly people were getting very optimistic about a certain type of share. And because it's very easy to fall in love with a particular story, you could help push those sort of themes and those sorts of excitements to unbelievably gargantuan levels, particularly at a time, as we see today, where interest rates are super low, and as a consequence, you can maybe borrow money on margin, or companies can, in terms of things like their DCF valuations, people can get very excited very quickly about the potential for those sorts of businesses. So for me, it's indicative of an unsustainable bit of excitement, and I certainly wouldn't be following it. And hence it fits with my earlier observation and conclusion that actually you should be a bit more cautious about the tech space going forward, which tends to push you more towards value investments, different types of markets than the States, and certainly a more sort of broad, active encompassing of opportunities. Great question, though. Okay, another question here. What do you think has been the impact on ESG investing? So that's the more environmental, social governance style investing of things like COVID. Now, ESG has been a huge theme for financial markets over the last 5 or so years. Many important reasons why that is so. Clearly, we see, despite all my comments about longevity and ingenuity of humans, you can easily make the case that we've done some silly things as well in terms of the environment and sort of some terrible trade-offs there in our pursuit of higher standards of living and everything else. Another debate, clearly. But in terms of specifically ESG investing and COVID, I think the two have been quite tightly linked, because certainly some of those ESG friendly areas, for example, electric vehicles, or certain areas of biotechnology, they fit into that area that we've just talked about in terms of areas which are very much hope investments. And if you're a hope investment, i.e. you're not making profits today, but you're sort of hoping there's going to be a certain type of future going forward, you benefit from enthusiasm for the financial markets, number one, cheap money, sort of low discount rates in DCF valuations and the like. Clearly there are some tailwinds in terms of themes, which I think would probably go beyond COVID-19. Clearly some of the technology names have benefited from obvious tailwinds associated with COVID-19. But I think when we go onto ESG, certainly the tech stocks tend to sort of rate quite well there. Certainly better than some kind of, you know, manufacturing centered metal basher, you know, some more traditional industry. Clearly they're going to have quite a poor ESG score potentially. So I think there's been a little bit of helpful coincidence, if you like, of these issues. But on ESG and COVID per se, I think it's harder. I think personally that there have been some natural benefits and wins from it, but does it mean that you must have, do the COVID issues mean that you must forever have a high ESG weighting? I think that's a more difficult thing. And certainly my observation is that ESG has clearly attracted a lot of flows recently, and it's also helped push a lot of the ESG friendly stocks up to some pretty high valuation levels. So put all of those together, my feeling is some of the areas which are not quite so ESG friendly are probably going to have a chance to outperform over upcoming months and years. And clearly that would include areas such as some of the commodity facing areas, for example, which are very out of favour at the moment. But during periods of inflationary fear or sort of mixed up conditions and the like, and certainly coming from where they're coming from in terms of low valuation, should actually be in quite good stead. We'll see. ESG is important, but I wonder whether the love for it at the moment and the flows towards it, perhaps that's been a little bit overdone. People have kind of allocated first, and perhaps need to think a little bit more carefully later, precisely what they're buying and at what valuation they're buying in at. Great question. They're the questions that have come up. Appreciate those questions, they were great. If there's no final questions, all I'll say is hopefully that was interesting. Really good to talk to you. If there's any further follow-ups, Josh and the rest of the team undoubtedly will be happy to field any further questions. But good luck with everything and stay well and best of luck. So Josh, I'm going to hand back to you now.
Hi, Chris, and hello, everyone. I'm Josh Papanicola, Alumni Manager for the Business School. Thank you very much for joining us today for the second event in our COVID-19 Thought Leadership series. And of course, a big thank you to Chris for his presentation, especially after the technical difficulties we had last week. If you joined us late or have a friend or colleague who couldn't make it today, the recording will be going up on the University of Exeter YouTube channel by the end of this week, so you can catch it there. We'll also send you a link in the follow-up email from your registration to this event. And just to let you know, our next COVID-19 Thought Leadership webinar will be a panel event in September on the theme of entrepreneurship and its importance as a skill. So look out for further details, including the time and date of that one, in your alumni emails, or further information will be available on the alumni website. Thank you very much again, and we hope to see you again at another webinar soon.